The US dollar took a slight step back against both the Japanese yen and the euro on Wednesday, following surprising news that producer prices in August actually decreased. This unexpected dip has strengthened market beliefs that the Federal Reserve is likely to cut interest rates later this month, a move that could significantly impact global financial markets. But here's where it gets controversial. How might this anticipated rate cut influence the dollar's performance in the coming weeks? And what does it mean for investors? After the release of the data, the dollar slipped a bit against the yen, settling at 147.37, while the euro edged up slightly to $1.1714. Earlier in the day, before this report shook the markets, the dollar had been showing moderate gains against both currencies, demonstrating how sensitive currency values are to shifts in economic indicators. Delving deeper, a recent Labor Department report revealed that the Producer Price Index, PPI, for final demand fell by 0.1% in August. This was quite surprising, especially when compared to July's numbers, which initially showed a 0.7% rise, but were later revised downwards. Economists surveyed by Reuters had anticipated the PPI would climb by 0.3%, following a previously reported 0.9% increase in July. So, the actual decrease defied these forecasts and injected fresh uncertainty into the markets. Looking at the bigger picture, the PPI's year-over-year growth slowed to 2.6% in August, well below the 3.3% rise experts expected. This deceleration suggests that inflationary pressures at the wholesale level might be easing. Carl Weinberg, chief economist at High Frequency Economics, commented via email that August's PPI report paints a much less scary picture of prices of goods in the pipeline compared to July. He further noted that while prices for core goods did increase, the rise was far less than economists had predicted, highlighting a cooling trend in factory-level inflation. What does this mean for the Federal Reserve? The market is currently pricing in a very high likelihood, a 90% chance, of a standard 25 basis point interest rate cut this month, with only a 10% chance that the cut will be a more substantial 50 basis points. Such questions invite diverse opinions. Some argue that the Fed's actions are prudent, while others worry they might fuel future instability. We'd love to hear what you think. Do you agree with the Fed's cautious approach, or do you anticipate unintended consequences from these interest rate moves? Share your thoughts and join the conversation.